Most investors believe war destroys wealth. Charlie Munger believed the opposite. Not because war is good, but because human psychology becomes predictable during chaos. And when psychology becomes predictable, markets misprice reality. Let me explain. When geopolitical conflict begins, the financial world reacts instantly. News channels flash red banners. Social media fills with fear. Portfolios drop, and investors start asking the same question. Should I sell before things get worse? This is where the majority make the most expensive decision of their investing lives. Because markets are not driven purely by facts. They are driven by fear, uncertainty, and herd behavior. Your brain is wired for survival, not investing. Thousands of years ago, fear kept humans alive. When danger appeared, the correct response was to run immediately. But the stock market punishes that instinct. During crises, your brain screams, protect yourself, sell everything, go to safety. Yet history shows something remarkable. Every major crisis, wars, financial crashes, pandemics, eventually created enormous opportunities for disciplined investors. Why? Because fear creates something professionals call a pricing moment. A pricing moment happens when assets temporarily trade far below their long-term value simply because investors are panicking. Great investors wait for these moments. Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." But understanding the quote is easy. Living by it during a crisis is extremely difficult. Because when markets fall, it feels like the world is ending. But history tells a different story. During wars and geopolitical conflicts, capital doesn't disappear, it rotates. Money flows towards sectors connected to the new reality. Energy companies often surge when supply becomes uncertain. Defense companies receive increased government spending. Gold attracts investors seeking perceived stability. Understanding where capital moves is one of the most powerful advantages an investor can have. But the biggest mistake investors make during crises isn't buying the wrong asset. It's selling the right one. When panic peaks, investors often liquidate quality businesses simply to escape emotional discomfort. Years later, those same assets are worth multiples of their panic price. Charlie Munger understood something simple but powerful. Markets reward patience far more than intelligence. The investor who remains calm while everyone else is panicking often wins. Not because they predicted the crisis, but because they refused to react emotionally. War creates uncertainty, but uncertainty creates opportunity. And the investors who build real wealth are rarely the ones who move the fastest. They are the ones who think the clearest when everyone else is afraid. Because in investing, the greatest advantage is not information. It is discipline.